Well, the US retail sales are likely to slow down. That's the consensus view coming in from the Walmart as well as the Home Depot management overnight from the US markets, and that's the reason we saw a sharp slide into the markets when it comes to the US. In fact, the S&P 500 retail index was down as much as 3.5%, the lowest that we have seen in the last 1 month. Walmart actually delivered its numbers overnight, and the Q4 numbers were actually not that bad given there was a lot of holiday season demand. But the problem is that for the coming year, the outlook is a lot more discerning, and that's the reason we are seeing the slide in the stocks today. In fact, Walmart says, and they're forecasted that full year earnings for calendar year 23 are going to be lower than what the street was penciling in. They said that they're cautious about the economic outlook for 2023 and that the consumers were likely to continue spending for lower priced items, and that could put pressure on their margins as well. In fact, they said that there's a lot of trepidation in the market and uncertainty regarding the economic outlook, and even though balance sheets continue to get thinner, savings rate is roughly half of what it was earlier. With the Fed interest rate hikes coming in, inflation continue to be on a higher side, and that tells them that shoppers are buying fewer discretionary items as grocery prices continue to remain high. So there's a reallocation of spend really happening, wherein the retailer is looking at buying perhaps the grocery and the essential items, and spend on discretionary is coming down, and that's why we are seeing that slowdown coming in from Walmart as well. In fact, it was something which was echoed by the management at Home Depot as well, wherein they reported the fourth fiscal earnings and they talked about a muted outlook going forward. They said that the same store sales growth are likely to remain flat in the coming year. So that's the kind of commentary coming in, and they said that they expect a decline in the annual EPS in the mid-single digit percentage in the year 2023. They're also saying that sales are likely to be flat, though they invest as much as $1 billion in the wage revision, and that is something that is going to impact their margins as well. In fact, on the margin front, even Walmart said that they're looking at heavier discounting, which means that the margins are going to remain under pressure for all of these companies. But the question is, what would be the impact on India? Well, the impact will actually be in two sense. In the sense, first, it puts the pressure overall on the retail demand because there is that feeling of slowdown with the discretionary spend going down, and secondly, it's about the companies which export to these players. So for instance, in India, there are companies like Wellspun India as well as Gokuldas Exports and others as well like Trent, which supply to a lot of these global retailers like Walmart, Home Depot, Target, etc., and the demand for these products is likely to come down. So even in terms of textiles, home improvements, we are going to see a bit of a decline. The companies are having export as a substantial part of the revenue book are these. So for Wellspun India, almost 94% of the revenue comes from exports. Similarly for Trident, it's at 59%. Indocount Industries also has a heavy exposure to exports with 93% of revenue contribution coming in for them from the export vertical, and Himmat Singh as well, 96% of the revenue comes from exports. And with the exports slowing down not only in US but UK and European region as well, this comes as a bit of a worrying sign for Indian exporters as well.
If you like this video, then like, share and subscribe to ET Now.